So debt is bad, right? Evil. Well, today I'm going to ask you a question that's going to blow your mind. So hang with us to the end here. All right, so first let's define what debt actually is. Okay, so many people will look at debt as money that you owe, right? They'll say assets or things that you own, while debt is things that you owe on, right? Anytime you owe money. This is really hard because for many people, they're not really certain about what debt really truly is, because think about this. If you think that debt is always money that you owe, well, don't you always owe for insurance payments on your car? Don't you always owe money on taxes? Trust me, that's never going away, right? You can never be debt-free on taxes. Don't you always owe money? So many times what happens when people become quote unquote debt-free, they never become financially free because they're always owing money. So what is debt really? If you ask an accountant or you look at an accounting term, debt, simply put, is negative equity. Negative equity. What do I mean by that? So have you ever bought a car before and maybe you drive off the lot and you're thinking you're so happy because you bought a car, you bought something real, you got a loan on it, and you're saying, okay, I've got this loan, but it's okay because I have a car. And then after you drive it off the lot, you just realize something. You said, oh crap, I just drove it off the lot and now it's worth less, isn't it? That car is now worth less than what I owe. So now I'm upside down in that car. That means if you try to sell off that car, yes, you could pay off some of your loan, but you wouldn't be able to pay off all of it. You'd have to come out of pocket with more money to pay off that loan. That is debt. It's not the money that you owe total, it's the money you have to come out of pocket to pay the rest. It's negative equity. Now the vice versa is true. If you had equity in that car, say that the car's worth $20,000, but you only owe $10,000, you have $10,000 of equity, correct? That means if you sold the car off, you would get $10,000 in cash. You would actually be debt-free. In that case, in fact, you'd have $10,000 more in cash coming back, wouldn't you? So remember, debt is not just having a loan. Debt is actually knowing that you have enough assets to pay off those loans. It's having it it's about having positive equity, not negative equity. So that negative equity is debt, whatever you're upside down. You bought a house. This happened in the last recession. Some people had a house that it was only worth $300,000, but they owed $400,000. They had $100,000 of debt. Not $400,000, that was a liability. They had $100,000 of debt that they were upside down in. That is debt. If you understand that, you start to realize you're debt-free. If you have positive net worth, you are, congratulations, debt-free. I can play the Braveheart music for you. You can say freedom, just like people do on the Dave Ramsey show, because you are debt-free. Congratulations. That's the true meaning of debt, right? Is being upside down, having negative equity. So many people get all worked up about this and they think, oh, it's horrible. Well, no, it's not. Now, I do agree. You need to be wise with debt. Don't fear debt, right? That's a scarcity emotion, but be wise with it. So many times, one of the mistakes that people do make is that they use the wrong kind of debt. What is kind of the obvious given is when people have high interest credit cards, or if they're getting payday loans or title loans, things with almost like loan shark rates, that can be the wrong kind of debt. The wrong kind of debt is something that obviously is costing you a lot more, to the point where you have to keep working your tail off to make those payments. Now, there are some good kinds of debt, in my opinion. I know some people say debt's always wrong, always bad, but I think there's some good kinds of debt. I think for using it for business purposes, for starting a wise business, I think it could be great for education, the right kind of education that is, getting a good car, getting a good home. And I don't say you have to get a massive mansion with that debt, right? I'm saying that you got these things that within reason, the numbers still work. That's great. Those kind of debts, especially when they're lower interest, they also a lot of times will have lower payments. Mortgages are a great example of that, where you can have lower payments. That's great. By the way, bonus tip here, if you want to use the right kind of debt, what many people don't do is kind of this third point here, is that they don't understand payments. They don't understand how that really works. One big mistake with people is that they try to pay off debt too fast. What I mean by it is that if you get a 30-year mortgage, your payment on a $200,000 mortgage is gonna be right now, right in the ballpark of about $1,200 a month on a $200,000 mortgage. But if you get a 15-year loan, even if they lower the interest a little bit, you're gonna be paying probably easily $1,600, $1,700 a month. Your payment is higher. That is higher risk. I actually had a client that came to me recently. He said, I'm really surprised because we save a lot of money and our credit score is perfect, but they denied me for a loan. They wouldn't let me get a 15-year mortgage. They would only let me get a 20 or a 30-year mortgage. And I said, well, yeah, because banks aren't stupid like most people are. Most people listen to guys like Dave Ramsey and they'll say, oh, I should get a 15 or 10-year mortgage. Let's pay this thing down fast. Here's the big risk. Banks love it. Just so you know, banks love it. That's why they give you the lower interest rate on the shorter term loans. Banks want you to pay it off faster because they can turn around and make more money with it quickly. If you get a 30-year mortgage, they're going to charge you the higher interest rate because they're at more risk because you may not pay it off. There might be something that happens in the meantime where you can't pay it and they're stuck with that property. Or if you pay it down quickly, then they get more equity. So if you stop making payments, they can take your property away from you, sell it, and get their money back. That's why they want you to pay off quicker. But this guy got denied not because he had a bad credit score, not because he had credit cards, because he didn't have those. It's because his debt to income ratio was too high, meaning that the mortgage payment was going to be too high for the percentage of money that he was earning. So they actually denied him because they said, no, that's too risky. Your payments would be too high. Anything goes wrong, you won't be able to pay us back. So even the bank thinks it's not smart to get a 10 or 15-year mortgage. So he ended up getting a 30-year mortgage. We had him refinance that. He paid a little bit more in interest, but you'll find out if you watch some of our other videos, actually that doesn't really make that much of a difference anyways. In fact, you can make a lot more money off of it. So not understanding payments. Another thing that people don't understand, one of the types that could be a wrong kind of debt to use sometimes is using a 401k loan. People don't realize that you can use either up to 50% of your 401k balance or $50,000, whichever is less, you can borrow from your 401k. But understand that even though the interest you pay, they actually have you pay you back your own interest. Even though you do that, the problem is that the payment is high. In fact, if you borrowed $50,000 from your 401k, they're gonna require coming out of your paychecks about $900 a month. Sometimes a little bit more, but roughly about $900 a month. Whether you like it or not, whether you need the money or not, that money's coming out of your paycheck. That can be a big, big risk, especially if you have $50,000. You better hope it's being used wisely for whatever you used it for. If you're trying to use it to invest, just so you know, you have to make at least a 22% rate of return on your money to make that payment to your 401k. That's not an easy feat to do. And hopefully you're not doing that to go do something crazy with it, right? So just so you know, those payments are not good. Here's the key point you want to remember. Get the lowest payment possible for whatever kind of debt you're getting. Even if it means it's a little bit more interest, it doesn't matter. Same thing with car loans. Get a longer term. Maybe instead of doing a 3-year car loan because you're trying to pay off fast, pay it off maybe in 5 or 6 years instead. And you'll find out that lower payment puts you in a safer place so that if anything goes wrong, you're gonna be more protected. Now, fourth point here is many mistakes people make is they use debt for the wrong things. Sometimes they do try to use debt to go into business ventures and do things that gamble with their money. Maybe they try to use it to, even just put into crazy stuff that they just blow money in, and it just creates more of a payment for something that they can't pay for. That's wrong. If you don't have the cash flow to pay for those things, that's bad. Use that 401k, even if you use it to buy real estate, which I think is a great thing. The thing is, if you can't make your payments because you're not making as much on the real estate payment, the cash flow as you are on the payment for the 401k, you're technically losing money, right? Even if you're making money in one place, you don't realize it, that can hurt you month to month. So be careful not using the wrong type of debt or use it for the wrong things, right? I definitely recommend that you use debt for buying real assets. You can use debt if you're gonna help consolidate and lower your monthly payments. Maybe it's a lower interest rate. Great, use it for that. Definitely don't use debt for investing in the stock market. Bad gamble. Don't buy crypto with it. Don't do any of this crazy type of things that you think you can make a quick buck. Stay away from that kind of stuff. Do things that you can manage and control your risk so that you don't gamble your livelihood away by using debt for the wrong things. But really we come down to, is debt really bad? Is debt really evil? And that's the thing that many people can't get out of their head. They think they've been so indoctrinated by banks, specifically, as banks want you to pay off debt faster, like I just described, but even by other financial pundits saying debt is horrible, and they hear all the horror stories. Debt can be bad, but if you are a wise steward, you can use it wisely. So is debt really bad? No, it's neither good nor bad. The question is really, are you good or bad with debt? That is the real question you should be asking yourself. If you're gonna be bad with debt, don't use it. But if you can do good things with it, great. We've had clients that actually use debt, using home equity loans, for example, using that to go buy real estate properties and make thousands of dollars more a month than what it was costing them. I even had one client who he was 6 years away from paying off his mortgage. I said, refinance your mortgage, get a lower payment instead of paying it off right now, lower the payment, which would save him some money, but then cash out some money too. So he's able to cash out an extra $400,000 from his mortgage, keeping the same payment. But now that $400,000 is making him over $40,000 a year passive income, which means it pays for his mortgage payment and he has surplus left over. Most people just try to pay their debt with all their extra money they make from their hard-earned dollars at work. He now got his dollars working for him, so it paid his mortgage payment and paid him passive income each and every month. Guys, that is what you have to do. So be careful Understand that you can use debt for the wrong kind of things. You can use the wrong kind of debt. You don't understand the payments, but ultimately, debt's not really bad or good. It really depends on, are you good or bad with debt? Okay guys, if you love this video, check out my react video to the returns of the stock market. And I'm gonna tell you, I was right. Check it out.